It is 6:03, and welcome to episode 2 of Keys to the 6:03, your real estate and business podcast. I'm your host, Shane. Today we're sitting down with Bill with Total Mortgage. And today's episode is all going to be about mortgages. So if you're a buyer, a seller, or if you're just curious to learn about mortgages, this episode is for you. So, Bill, why don't you introduce yourself? Tell us a little about yourself, how you got into the mortgage lending world.
Yeah, that's a long question. No, so I'm Bill Gaudet. I'm a loan officer here with Total Mortgage. I do mortgages mainly in New Hampshire, Maine, Massachusetts. I'm also licensed in Florida because when you're in New England, everybody likes to go to Florida.
Of
So
course, yeah.
we have that too. But yeah, so I got into mortgages just before COVID. And I'll tell you, when you ask anybody, everybody gets into mortgage, they kind of fall into it. Nobody graduates high school or says, I want to be a loan officer when I grow up. It's just not the career path most people have in their minds. But I will tell you, it was the best thing that ever happened to me. I mean, the short story being that my daughter was born in March of 2019. I was working in restaurant management. I said I need to get out of it. So to do have a better schedule. So I started looking for another career, and this one came upon me, and it has been the best thing that ever happened to me and my family, honestly, because I have the flexibility of time that I can go do things with them and be a part of my kids' life in a much more meaningful way by having this career. So it's been one of the best things to ever happen to me.
Absolutely. That's awesome. Sometimes it takes just a simple little career change.
Yeah.
To really make a big difference in your life, kind of like me going into real estate from being a paramedic.
hmm
But getting into being a mortgage officer during COVID, was there any challenges you had to face getting into it?
I mean, yeah, there's a lot of challenges. I think that the biggest thing was that because I was brand new, a lot of the COVID time was a really, really busy time in mortgages, but it was a lot of refinances, right?
Gotcha.
Because rates went down. So there was this huge refinance boom. And I think that it caused a lot of people refinance into those 2 and 3% interest rates. I think what ended up happening was, for me, I didn't have a database of people to refinance, right? So I was calling people, friends, family, whoever I knew,
Course,
hey, you
yeah.
want to refinance, you want a lower rate. And so I had some of that, but most of my focus had to be on purchases because I didn't have a database of past clients. So I still focused a lot on purchases. So it was difficult because I was starting in this really busy market without any real database. Beyond that, though, I had a lot of my learning from, my mentors came virtually because I had a couple of months and then everybody was home and we weren't allowed to see each other. And so that was definitely an issue that I had to work through. But you know what? I honestly think that it made me better for it. I was able to get through a really, really busy, crazy market and came out the other side, and I'm still here. So
Awesome. Yeah. So it sounds like, that getting through that situation took a lot of determination, dedication, a lot of hours, a lot of work. How
yeah.
would you say that's helped you with your business now?
Well, I think it prepared me for anything, right?
Yeah.
I'm prepared to work long hours. I'm prepared to do things virtually if I have to, in person if I have to. I can kind of mold to whatever the situation is because I mean during COVID you had to.
Totally.
You
Yeah.
didn't have options. You just had to make it work. And without networking events, you had to find a way to get in front of realtors. Without, first-time home buyer classes, you had to find a way to get in front of home buyers. All of those things. We didn't have the availability of the in-person shake a hand, hand a business card. So we had to find alternate ways to do that. So it's just, now gives me all sorts of ways because I have those alternate ways and I have the traditional ways.
Of
So it
course.
makes it even better.
Totally, yeah, and absolutely. I mean, during COVID, people were terrified to even go outside, let alone have a handshake meeting with someone and talk about mortgages. But I imagine now that since COVID is over, you're getting out into the public a lot more, doing a lot more networking
Oh,
events, face-to-face meetings. I imagine that's a
yes.
whole new world for you now.
Well, I mean, we're a few years into it now, but yeah, it took a little bit of getting used to actually getting back in front of people, and networking with referral partners or getting meeting with potential buyers or any of those kind of things. It took a little bit of getting used to because I mean, the first couple of years of my career was behind a camera pretty much, behind the computer screen, talking to people like that way. And so I got used to it. But you know what, for me, I feel like I'm thriving more in the world now where we have the person to person in person touch, they call it belly to belly marketing,
Belly to belly. I like it.
I love that. I love being, around people. I get energy from that. I enjoy going to things, going out to lunch with somebody, or meeting for coffee, or going to a networking event, or even, doing a community service event. Like that's 90% of what I do in my marketing now, and I love it.
Absolutely, yeah, and I definitely think, doing a lot of that tabletop face-to-face stuff means a lot to people. So I think during COVID, a lot of people, got really used to seeing people behind screens and communicating with people in non-traditional ways. And I think one thing people are striving for is that connection, is that face-to-face, sharing those emotions and having experiences with people.
Yeah.
I think is something that people missed out on. So talking about home loans, anytime I'm talking to people who have been looking into real estate for a little bit, who are brand new to real estate, they don't really know a whole lot about home loans. A lot of them just think, oh my God, I can't afford it. And that's a lot of what people think. So, can you tell me a little bit about the different types of home loans and how those might apply to people in different scenarios?
Yeah, I mean that's a whole podcast episode of its own. But
Absolutely.
the Cliffs Notes version here, yeah. So your basic loan programs, you have conventional loan, you have FHA, VA, USDA. Those are the big four: conventional,
Course.
FHA, USDA, and VA. Conventional breaks down, and you have Fannie Mae and Freddie Mac. And you probably have heard these buzzwords
Yeah, totally.
before. Every loan program has its own quirks and differences. But the basics of it are that when somebody applies, they really want to let the loan officer kind of let them know what kind of loan programs. And I'm not saying you don't have to be educated about it, but I always find it funny when I have somebody reach out to me and say, "Hey, I'd like to talk to you about applying for an FHA loan," which may or may not be the right loan program for them,
Right.
right? And I had somebody walk into my office one time off the street, just walk into the office. "Hi, can I talk to somebody about an FHA loan?" Sure. In the end, it actually ended up being the right loan program for him. He was a first-time home buyer. There are a couple of specifics that made FHA the best option. That's not always the case,
Right.
because he actually referred me somebody about a year later. He said, "Oh, I got a friend that wants to buy a house. Can you talk to him about an FHA loan?" I'm like, dude, maybe. And this guy ended up with a conventional loan.
Of course.
Just every buyer's different. It's like they talk about fingerprints, or every fingerprint's
Yep.
different, or every snowflake is different. Every buyer's different, right? So you really have to look at all the information and say, okay, where do they fit in here? You have like VA loans, obviously. So VA loans are for veteran buyers, right?
Yep.
You have to qualify through the Veterans Administration to have a VA backed loan. Not all veterans are going to qualify, and not all veterans, it's going to be the best loan program for them. A lot of them are, right? It's a great loan program. It's a
Totally.
great
Yeah.
benefit of having served our country. But in the end, I've had people come to me that are veterans that think they want a VA loan, and they're like, "Well, I'm going to put down 20% and I'm going to do this." I'm like, "Listen, the VA loan may not be your best option. Let's look at this option here." So you really have to, number one, as a buyer, find a loan officer that you trust to have your best interest at heart, right? But when you do that, kind of let go and let them guide you to what the best loan program is going to be for you,
Totally.
because it's just so many of them.
How do you help best determine what your client needs? Like if someone comes to you and says, I want an FHA loan, I want a VA loan, I want a USDA loan, what's your process like? How do you fine tooth each
Yeah,
interaction and give somebody exactly what it is that they need versus what they think they
they
need?
think they need.
Yeah,
Yeah. So I mean, my first conversation is always, what are your goals?
of course.
Right. And what I mean, what are your goals? Obviously, their goal is to buy a house, right? But what I mean by what their goals are, is their goal to have the lowest payment possible? Is their goal to have the least out of pocket cost possible? Because lowest payment and least out of pocket cost don't necessarily go hand in hand,
Right.
right? You can have a much lower payment with a higher out of pocket cost, and vice versa. Is their goal like do they need down payment assistance? What are they looking to do to buy a house? Like, what's their end result? To buy a house, but be in this situation. So we had that conversation, and I kind of probe some questions out of them for that. I'll talk to them about, where they think their credit score is, what do they have for down payment and closing cost funds, what, those kind of things, with their job, because that can affect it depending on your job history. One program might allow a certain job history than another, right? If you've had, so again, not to get into the nitty gritty details
course,
of
yeah.
it, but there's a lot of factors that go into making that decision of which program is going to work. And sometimes we start in one program and then something comes to light and we go, "Oh, that's not going to work. Let's go into this program."
Of
Right.
course. Yeah. So throughout the process, you can kind of tailor it to their specific
Correct.
needs. And if things
Correct.
change, you can change the
Yeah, and I might say,
accommodate
hey, you've got these 3 options that could all be good options for you, but we're going to decide that when we're actually ready to put an offer on this house.
that. Perfect.
Because this house might not be a good option for this one, but this house might, right? So I think buyers need to be ready to be kind of quick on their feet about making those decisions last minute about which program is going to be best. There's sometimes people go under contract with a program, and we'll get into it and I'll go, you know what? Actually, this one might be better for you. So my job is to find you the best program that's going to fit your needs the most. And it's not always about what's the lowest rate or what's the cheapest this, or that's not always the best program,
Absolutely,
right? What's
yeah.
going to be your best program for your long-term and short-term goals?
Absolutely. And I think that's a really important, thing for buyers to understand getting into today's market. I think a lot of people get in and feel like they're boxed into one mortgage idea. If they're like, oh, I know I can do an FHA loan, or I know I can do a VA loan. A lot of
Right.
people, I feel like, get boxed into the mindset where they think that's the only option. So I think it's great for buyers to know that you're not stuck in one category. You can move around depending on what your needs are, what changes, and depending on what's going to be most beneficial
Correct.
based on, your recommendation and your guys' conversations together.
Correct. Yep.
And so, the first thing that people ask is always about home loans because no one really knows about it. And the second thing, this is the big buzz right now, interest rates.
Yeah.
So let's dive into that a little bit because
Sure.
that is almost 100% of my conversations with any buyer, seller, anyone real estate is interest rates.
And you know what? Unfortunately, that's the only thing that most home buyers know about, right?
Yep.
It's the buzzword, it's interest rates, right? They go, I'm going to buy a house. What's the interest rate? And again, I go back to my first point about the interest rate's not necessarily the most important part of it. And I mean, it's a major driver,
Of course,
right? But in the end, there's so many other factors that go into it. And it again goes back to what are your goals, right?
Yep.
People say, well, I want the lowest interest rate possible. Well, I got to tell you, the lowest interest rate possible might end up being the most expensive option, right? Because I can give you a really low interest rate and you're going to be charged points. And I don't know if you know what points. So a discount points on an interest rate is you can buy down your rate for a percentage of what your loan amount is. So it's kind of like upfront interest.
Right.
I can give you a lower rate for that.
Yeah.
But again, it's going to cause your out-of-pocket cost to go up. And sometimes depending on the loan amount, quite a bit.
Absolutely.
Right. So when you got to look at kind of the pros and cons of that, do you buy down your rate to a much lower rate, or do you say, hey, I'm going to have this rate for a little bit, and hopefully if rates come down in a year or two, then I could refinance. It might be cheaper to wait and refinance, right? So we have that conversation. And again, everybody's different. Some people, it makes sense to buy it down. Some people,
Totally.
it doesn't make sense to buy it down. It all depends on what their particular situation is. Some people that are really, really on the edge of qualifying, maybe we need to buy them down so they qualify for the house they want to buy, right? So, but they've got the extra cash available to do that. So there's all those different things that are going to go into it. The thing with interest rates is that when you're shopping around with different lenders, the biggest thing you want to look at is not the actual interest rate, but the APR.
Okay.
Right, because the APR is a really easy way to explain it is it's the cost of your loan expressed as a rate, right? So it includes the interest rate, but it also adds in all the other closing costs to have to do with that loan.
Of course.
So you have these other loan costs that are built in. So if you were to buy a house cash, these costs wouldn't be there, right? So you have these loan costs that are adding to it. And one of those things is like those discount points.
Right.
So I'll get, somebody says, oh, well, this company XYZ just sent me, an estimate and their rate is, half a point lower than yours. Can you beat that rate? And I go and look at it. It's like, yeah, sure. I can beat that rate if I also charge you the 2 points that they're charging.
Totally. Yeah.
Right. Why are they charging 2 points? So they can show a lower rate. Right. So, and that's not always going to be the case. Some companies may be lower than me. I may be lower than others. It changes all the time. But in the end, it's a matter of the whole picture.
Of course.
Right.
Yeah.
And so you can't zero in on interest rate as everything. And sometimes I think, especially first-time home buyers, but even people that aren't first-time home buyers get caught up on what's the rate. That's, have people call me, what's the rate today? I don't know what your rate is. Rates are as different as people are, right? So it depends on your situation. Are you buying a single family home? Are you buying a multifamily? Are you buying a condo? Are you buying a mobile home? Or you buy, do you want a 15-year loan? Do you want a 30-year loan? Is it an FHA? Is it a VA? Is it a USDA? Is it a conventional? Is it a non-QM loan, which is a whole different category, so there's all different types of loan programs. And the rate, like, what's your rate today? That's people's favorite question to ask me.
Of course,
You work in mortgages? What's the rate right now? I don't know.
Yeah. Yeah. What's the rate?
What's the rate for this scenario? I could tell you if you bought a house at this much and you put down this much and your credit was this much and you was this kind of house. Like, if I have all these qualifiers, I could figure it out pretty quickly.
Of course. Yeah.
But there's no what's the rate. You know,
Right.
my other favorite thing is people will Google today's mortgage rate for a 30-year loan, and Google will show you what the national average is. And it's nowhere near what you probably are actually going to have, you know, up or down, right? Because again, the national average,
Of course.
and
Yep.
and the average can, you know, includes all sorts of things, you know, and because a 30-year mortgage, you don't know if they were putting down 50% or if they were putting down 3%, right? So it takes an average. So when people say, well, my rate should be lower because this is what the rate is right now, not necessarily.
Yeah, the averages don't take into consideration outliers and additional factors
Right.
and everything that makes mortgage lending, you know, what it is.
Correct.
So would you say that you think, would you agree with the statement that it's a mistake for new home buyers and even older home buyers to focus in on the interest rate and make the determination to buy a home solely based on that? Because
Right.
that seems to be a lot of what's going on today.
Right. Yeah.
A lot of people are really honed in on that interest rate, and a lot of people want to wait for them to lower. Do you think there's any possibility that's going to happen anytime soon, that it's going to lower to the point where everyone's going to flood the market again like 2019?
Well, my crystal ball's in the shop right now.
Oh, gotcha. All
But
right.
if I
I'll come back
had it
next week
here,
then.
yeah, it's a little, it's on the fritz. The thing is that I don't know.
Yeah,
Right. I've been
of
right
course.
as many times as I've been wrong. Probably actually wrong more than I've been right when I've tried to predict those things. Do I expect that rates will come down from their current level? Yeah. When? I don't know. You know, it could be soon. It could be, you know, so people were saying we're going to be in the fives by the end of 2024. That didn't happen.
Yep.
People are saying, oh, we're going to be in the fives by the end of 2025. Maybe. Who knows, right?
Of course, yeah.
The one thing I can say with a certain amount of surety is we're probably not going to be in the twos. You know, so if you're sitting there waiting for it to get back into the twos like we were in 2021, we may never see those again. Threes even, we might, but we might not ever even see 3% rates again.
I mean,
you know,
the rates we saw in 2019, they were historical.
they were, yeah. So during COVID, the rates had historic lows. We'd never had them that low before, and probably will never again because the rates were tied to COVID happening.
Correct.
So if we see those rates again, more than likely there's some big problems,
Of course.
in our world that's causing the interest rates to go down. And again, that's a whole other podcast episode, how rates are determined.
Totally.
But just the fact being that if rates are really low, it means the economy is probably not that fantastic. One of the reasons rates are high is because we had all this inflation, you know, and the economy was almost running too fast, which is why they kept raising the Fed funds rate to try to slow it down some because of the inflation. I mean, again, we can get into a lot of that, you know, in much more detail another time if you want. But the fact being that rates are where they need to be.
Absolutely. Yeah.
You know, and that shouldn't be, if you can afford the payment, the actual rate should not be as important about you deciding whether to buy a house or not, you know, and when you shop around, you might, you know, an eighth, maybe a half tops, you're going to see a difference, which can make a difference, but it's not like most mortgage companies and banks are going to have very similar rates.
Of course.
I mean, for me, I say you want to be looking at the costs of the loan, right? What are they charging you for your closing costs? Because that's cash out of pocket, right? The rates it's amortized 30 years, right? So the rates is what it is, and you can refinance later. But what's the cost of the house? What are the costs of the closing costs the fees that are being charged? And then the other thing is that service, right? People, you know, you can go to on certain unnamed online mortgage lenders. Great, you can go there and they probably are, you know, advertising super low rates. Well, when you call them, they may or may not be able to give you that rate because again, there's certain situations, right? But also look at the service. You know, we live in New England. New England is a very local market, right? People like local in New England. We're New Englanders. We want the guy next door. We want to, you know, buy from our local bakery. We want to get from our local farmer. We should be getting from our local mortgage banker too, you know? So you want somebody that knows your community, that knows the area, that's going to care about whether you actually close that deal or not. right? So that's more important, I feel, than a lot of the other things about just basic interest rate. So is it important? Yes. But it's not the only factor when choosing who to work with for a mortgage.
And I think that's definitely important because especially, with people getting caught up on the mortgage, you might find a really nice interest rate. You might find something that you're like, wow, I really like this, and you're getting it from a computer that's not even, programmed in the same state that you're in,
Right.
versus if you stop at a local shop, somebody you can talk to in person, you're going to get that service. And
Correct.
that's going to be really what the bread and butter of you getting your loan is.
Yeah, well, and also understand that rates change every day. Sometimes
course.
multiple times a day.
Yeah.
Right. I've had, I've quoted somebody a rate in the morning and it's different by afternoon because the market's open, things change. There's volatility. You can go up or down. Right. So the biggest thing is knowing that when I pre-approve you, I'm going to pre-approve you based on this is what the rate is now.
Yep.
If it takes you 4 months to find a house,
it's going to be different.
It's going to be different. It might not be. You might beat the exact same rate. Who knows, right? But it's likely going to be different. My favorite is when people, I'll talk to somebody and I'll pre-approve them, and we'll talk here and there, and then they go under contract and they say, oh, well, this person can give me a better rate than you. And I'm like, what do you mean a better rate than me? I haven't even given you the rate.
Of course.
Like, oh, well, you said this is the rate. I'm like, that was 5 months ago, man.
Yeah.
Like 2 days later, that rate's expired. Like there's no, until you've actually locked in a rate where you actually have the conversation and say, I want to lock in this rate for this amount of time, that rate's, can change.
Of course. Absolutely. And, I think so. Hear that, buyers, for those who want to wait for interest rates to drop, it's better to wait for another pandemic because that'll be more predictive of what's going to happen with the rates.
Yeah. I would say too, understand that, are rates likely to drop? Yes. Are they guaranteed to? No. I saw a statistic recently. I don't remember all the specifics of it, but it said something like, rates were in the sevens in like 1970 something, and they didn't go down again until 1990 something,
Yeah.
So do you want to wait 15 years to buy a house?
So they went down, but that's 15, 20 years of memories in your home that you're not making.
And rates went up in between. So people are like, okay, I'm waiting for the rates to go down. But and the other thing too, they have to people remember is how much interest are you paying in your rent?
It's a good point.
The answer is 100%.
Yeah.
Because $0 of your rent is going back to you in equity.
Yeah.
$0.
You're making no equity.
You're paying somebody else's mortgage, then they're gaining equity, and
Correct.
they're becoming wealthy on your back as a renter. And you know what? Renting is important. Like it's
absolutely.
There is a purpose for it, and we want to make sure we have rentals. We want to make sure they're affordable. We want landlords to have those investment properties so people can have rentals, because not everybody's going to be able to buy a house.
Of course.
And even most people that are not going to at all times be able to buy a house. So renting is important, and having that market's important. But when you rent, it benefits you zero besides having a roof over your head.
Yep.
That's it. So when you own a house, that mortgage payment, yes, a lot of it's going to interest and taxes and insurance and all that stuff. But a small portion at the beginning, more and more as you pay, more and more the longer you have the loan, but a small portion is going toward the principal, toward your actual loan. But that, not only that, it's the actual market where I don't know exactly how much right now there's, growth is in terms of value, but I'll tell you, over the last 5 years, it's been a lot.
Of course.
So somebody that chose in 2019, I'm not going to buy right now, I'm going to wait. And then they waited even longer, and then rates started going up, and like, oh, we'll wait for them to come back down. Well, guess what? You still haven't bought. That's 5 years, 6 years of you paying. I mean, think about it. Somebody that's paying $2,000 a month, which is a pretty average rent right now, sometimes low depending on the area, right? But in like Rochester, probably $2,000 a month for a two-bedroom apartment. So you pay $2,000 a month. That's $24,000 a year. $24,000 a year times 5 years. Come on.
Yeah.
I mean, like, how much money is that you're literally throwing away?
Of course.
That you could be putting toward now in those 5 years. Let's say you pay a $2,000, or let's even pay a $3,000 a month mortgage payment. All right, a portion of that's going toward your loan, so you're owing less and less on the house every month. But also the value, just the market value of your house, is going up incrementally, but it's going up. So if you wait to buy that house that you could have bought, that the value is going up, the value is still going up. You're now going to pay more for that house 5 years on than you would have And even if the rate's lower, you might end up having a payment because you're paying more for that same house.
Yeah. I mean,
I
it's
mean,
no secret that as time goes on, house values have risen. And yes, like you said, in the last 5 years, it's been astronomical. And who knows what it's going to do in the future. But it is important to highlight that waiting to purchase a home based on interest rate or based on another factor like that can end up costing you money in the
yeah,
long run.
you need to buy a house when you're ready to buy a house.
Of course.
Regardless of the outside situations. Don't wait for the housing market to crash, because I'm telling you, in New Hampshire, who knows if or when that'll ever happen.
Yeah.
Because it's a really strong housing market and it's expected to stay that way. And if you're waiting for the rates to go down, who knows when that's going to happen? I'm waiting for rates to go down too. I would love to have a lower interest rate, make my job a whole lot easier with lower interest rates. When's that going to happen? And what are you losing between now and then?
Of course. Yeah.
So I'd say if you're considering buying a house, reach out to a loan officer, have them run numbers for you and let you know where you're at right now. That doesn't mean it doesn't cost anything to do that, by the way. If you do that, it doesn't mean you have to buy a house right now. It means you say, you know what? It's not affordable. Okay, I'm going to wait. Find out what is affordable. Make a plan for what did it have to be for you to be affordable for you, right? I think most people would probably be surprised at how ready they are to buy a house.
So let's talk a little bit about that. Somebody thinks they're ready and they want to come talk to you. How does that process start? You have pre-approvals and you have pre-qualification. What's the difference between the two? What is that?
Pre-qualification and pre-approval are often used interchangeably, and every company is different in what they call a pre-qual or pre-approval. The basics of it, and again, this is my definition of it.
Yep.
A pre-qual is you call me up or we have a meeting and you say that your credit is this and you say that you make this much money and you say this and I run the numbers and I go, yeah, okay, well, you're pre-qualified for XYZ.
Of course.
Amount, right? And let me actually interject, by the way. We're not pre-approving or pre-qualifying you for a purchase price. What we're actually doing is pre-approving or pre-qualifying you for a payment amount.
For a monthly payment.
Right? This is the payment that you qualify for. What does that mean in terms of purchase price, taxes, insurance, all that, right? So in the end, I can say to somebody, well, you're pre-approved for $500,000. But if they buy a house in a lower tax town, that might be $520,000.
Right.
If they buy it in a super high tax town, it might only be $450,000. Right. It really depends on the particular property because there's a lot of those X factors that we don't know until you actually have the house in front of you. So just keep that in mind too. But anyway, pre-qual versus pre-approval. A pre-approval is when I'm pulling your credit.
Yep.
I'm actually looking at your credit report, so I know what your credit score is. I know what the debts that you have, and I'm looking at your W-2s. I'm looking at your bank statements. I'm looking at your pay stubs. I'm calculating your income. I'm looking at what you have for assets, what your actual debt to income ratio is. I'm looking at all those details, and then I'm running it through our automated system, which has a whole algorithm there that spits out, okay, based on all this information that you have actually confirmed with documentation, this person is pre-approved. So it's a longer process, right?
Of course.
It doesn't have to take, I can do a pre-approval. If I have everything, I can have it, an hour maybe for an easy one. Sometimes people that are self-employed or have multiple employment, it can take a little bit longer to do all of it. A pre-approval doesn't take a long time to physically do. But it does require that the buyer get me what I need.
Of course.
Right? And that means pay stubs, multiple pay stubs. It means W-2s. It means bank statements. It means, possibly it means child support agreements. Sometimes it means disability forms. There's a lot. Everybody's different, but depending on their situation, they might require different things. If you're buying a house, you already own a house. Well, I'm going to need mortgage statements from your current house. I'm going to need your tax bills, things like that. So we can work together to get those things. If I have everything though, and I've qualified you based on that, now it's a pre-approval.
Of course. So it's paperwork, but it's obtainable
It's
paperwork.
super
Stuff that
obtainable.
people
And
can
again, it
get by
doesn't
reaching out
cost
to your
you
employer,
anything.
yeah.
Yeah, yeah, we might need to, depending on, maybe you have some hinky stuff in how you get paid, and maybe overtime and bonuses or commissions. Maybe we have to reach out to your employer and get a verification on all those things, right? Because some things we need to average over 2 years. Well, you may not have paperwork showing what the exactly how much overtime you made in 2023 and 2024. So we
Of
might need
course,
to
yeah.
reach out to your employer for that. So we do all those things ahead of time. That gives you that pre-approval. So when I hand you a pre-approval letter that you're using to that's going to be submitted with an offer on a house, that for me, I'm putting my name on there. I want those realtors that are looking at it, the seller, to know that that is as good as gold.
Of course, yeah.
Right? Because I've gone through the process. And the other thing to say too is, as a buyer, don't try to hide things from your loan officer.
They always find out, don't they?
We're going to find out. And I would rather find out at the very beginning so we can find a solution, or in worst case, say this isn't going to work, right?
Yeah.
But hopefully we can find a solution to work around it, instead of it popping up when you're under contract and you've already spent money on an appraisal and you've already spent money on all this stuff. And then I have to call you and say, hey, this came up. You never told me about this. Now I have to deny the loan.
Yeah, and you don't want to be, on the hook for something during that closing period of a house, because I mean, depending on the contracts you've signed and the terms of your contract, if you find out then you can't afford it because you weren't upfront about something, you may be on the hook
Right.
for the down payment that you've made, the earnest deposit
money,
that
yep.
you've made. You may be on the hook for that. There may be other, liabilities that you're responsible for just
Right.
because you weren't upfront about
Yeah.
something early on.
And
in
generally,
the process.
if your loan is denied, then you can usually, the seller will give you back that earnest money deposit.
Right, yeah.
And I say usually because
Yep.
not always, because
course.
if it's 3 days before closing and you're past that commitment date or whatever the case may be, they may have the right to keep it. But also, you've spent money on an appraisal. That money doesn't come back.
Yeah.
You've spent money on inspections. That
None
money
of that
doesn't
comes
come
back.
back. You don't get that refunded. You might have even spent money on moving boxes, right? Other things like that to prepare yourself. If you don't get that money back, you already packed up your house and now I have to call you and say I'm denying the loan. It's a lot easier to just be honest up front.
Of course. When you had mentioned a little bit about pulling somebody's credit score, how much does a credit score actually affect their ability to get a home loan?
It's probably the most important factor of the loan process is your credit. Now, I'm not going to say that somebody that has mediocre or poor credit can't buy a house.
Of course.
But again, it goes back to what loan program are we
Yep.
going to use, right? So that I'm not going to say, hey, you have to have a minimum credit score of this, because even somebody that has that minimum credit score, some things on their credit report might flag, issues like derogatory issues they've had in the past that are showing on there that might cause my automated system go, whoa, no, we're not going to approve this, right? So it's not a perfect science, but credit, I always talk about a triangle, like credit's at the top of the triangle. It's that angle at the very top. And that's the important thing, because credit's going to determine, do you qualify for a mortgage or not?
Of course.
And then it comes down to income. Income is it's the lower side, because it's going to determine how much of a mortgage you qualify for, right? Obviously there's we might have income that's not qualifying at all, and then you wouldn't be able to do it. But generally, if your income is generally qualifying you, it's a matter of how much you qualify for, right? Your income and your debt, I should say too, because that
makes
affects
sense,
that qualifying amount. And the third part, that third angle is assets. It's like down payment funds, closing cost funds. What do you have? Reserve funds. Sometimes some programs require you to have reserves that aren't spent, but you just have to show you have them.
Of course.
So those three are kind of the pillars of mortgage lending.
Okay, yeah.
And I always contend the most important is credit.
Totally. And I know when it comes to credit, some people are concerned about having a soft or a hard pull on a credit score. How much does that actually affect their score, and should they be worried about that when getting a pre-approval? Or
hard credit pulls do have an effect on your score.
Yep.
It's a public inquiry that dings your credit. It's different for different people. If you have a lot of them, the more you get, the more it hurts, because the credit, reporting agencies are going, whoa, what are you doing with all your credit here, right? And it's a risk. Everything's about risk, right?
Of course, yeah.
So the more times your credit is pulled, they go, oh, there's a lot of risk. Now, that said, that for mortgages, if you want to shop around, you have a window. I think it's usually like 14 days. When a mortgage company, if I pull your credit and I do a hard credit pull, you've got like a 14-day window to have your credit pulled by other mortgage companies.
Specifically mortgage companies.
Specifically mortgages.
Can't be
a
auto
mortgage
loans.
pull multiple times, and it still only counts for that first. So then they do that because they want to encourage people to shop around a little bit.
Of course, yeah.
Now, me personally, I don't do a hard credit pull unless I have to initially.
Of course.
Because I can do a soft credit pull and it's going to give me the same amount of information and it's not going to ding your credit. It's not going to hurt you. You're not going to have that window that you have to go rush out and get I can do a soft credit pull and get all the information that I need. I can run those findings through my automated system, everything. And that's something that not every lender can do. Some lenders can only do hard credit pulls.
Right.
For me, a total mortgage, I can do a soft pull. I can run it through my systems. I can do a lot with just that soft pull. So generally what I try to do, and again, I say generally because every situation is different, but generally what I try to do is I try to do a soft credit pull, and I'm not going to do the hard pull until you're actually ready to go under contract. Because it might be 6 months. I just closed a loan the other day that people were looking for 2 years.
Wow, 2 years.
If I did a hard credit pull every 4 months to keep their pre-approval up, how many times would that have hurt their credit?
Of course, quite a bit.
So I like doing the soft pull. It allows me to get the information that I need to do it. It's the same information that comes off of a hard pull. So if you're out there, you're looking and you're worried about that, then definitely find a lender that can do a soft credit pull for you.
Absolutely. Perfect. So in talking about buyers, we talked about how sometimes if they're not upfront with everything they have, it might affect them later on. Are there any other common mistakes that buyers might make that they might not think about going into the mortgage process?
So
there's some tidbits that people could keep in mind.
So when you apply, whether you're applying for a pre-approval or once you're actually under contract and doing a true loan application, it's a snapshot, right? We do that credit pull. We look at it's a snapshot of information. If that stuff changes during the process, it can affect your loan, right? Things like if you decide to quit your job, well, now that income we just qualified you with is no longer there. Even if you get a different job, it doesn't, even if you're making more money, it does not necessarily mean that you're going to still qualify for that same program.
Yep.
Opening other credit, the one I see the most is, we'll do a credit report, everything's good, and then the week before, somebody went to Kohl's and they offered them 30% off of their $100 shopping spree that day, and they're like, oh, I want to save 30%. I'm going to open the Kohl's credit card, and now all of a sudden we have a new inquiry, and now all of a sudden it changed their credit report. And for people that have an 800 or 750 credit score, maybe it's not going to matter much.
Of course, yeah.
But somebody that's marginal.
Yep.
That's got a 620 credit score or even less potentially. They're right on the edge of qualifying for their program. And now that inquiry happened and it pushed them over. So now they no longer qualify. Or their debt to income. So now they have a new credit card with $100 on it that minimum payment of $25 might push them over their debt to income limit because they were right at the edge. And I try not to keep people right at the edge, but sometimes it happens.
Of course.
So what I always once I pull your credit, hard pull especially, pretend that your credit's frozen. In fact, call the credit agencies and freeze it if you want to.
Yeah.
Right? Because if something changes on there, it might change. But the big one I always get is, well, what if I get into a car accident and I have to buy a new car? Call me first.
Of course.
We'll talk about it. Because usually you already have a car. Most people have a car loan. So now we're going to replace it with a different car loan. And as long as the payment's not that much different, it probably won't matter, right? Probably. So once you're under contract, especially, any of these big financial things, depositing money, your grandmother gives you $1,000 for your birthday. Nice. Thanks, Grandma. I wish my grandma gave me $1,000 for my birthday. But let's just say your grandmother gives you $1,000 for your birthday because she knows you're buying a house.
Of course.
Well, now guess what? That money needs to be verified, right? So there's all sorts of things that go into it. So my buyers that I love the most, the ones that call me with the silly, can I make my student loan payment? Yes, you can make your student loan payment. Do your normal everyday, keep paying your bills like normal, please.
Yes. Especially
don't make, debt payments late, but pay your bills like normal. If you have a guy coming to clean the chimney, yeah, fine. Let him come clean the chimney and you pay him. Your car needs an oil change, go to get an oil changed. But those big things, talk to me. And I would rather you talk to me about silly things that it's like, don't worry about that, than you not talking to me about the big things and it becoming an issue.
Of course.
So become best friends with your loan officer, especially when you're under contract.
Totally, yeah. So, don't be afraid to spend money on bills and things that are necessity, things that matter, but just don't go crazy on your credit
go
card.
grocery shopping.
Yeah, of course.
If you go to Costco once a month, go to Costco still. Do your thing, but don't open new credit. And that means credit cards, buying a car, installment loan. You're like, oh, I can consolidate my debt. You might get an offer to consolidate. Wait until after you buy the house to consolidate your debt. Wait till you have to buy the house to buy the car. Wait till you buy the house and then open all the credit cards you want. Just be there on closing day, sign on the dotted line, and then go do those things.
Of course. So when it comes to home buying, a lot of people have a lot of concerns. There's a lot of questions. How do you best address, let's say if someone comes up to you and they're super anxious about the pre-approval or super anxious about the loan or about not spending money? How do you address that in a way that benefits them, not in the immediate moment, but throughout the next couple of weeks in their transaction?
Yeah, I mean, in the immediate moment, I try to get them to understand, like, listen, it's a stressful process no matter what. Even the best of real estate transactions are going to be stressful from time to time.
Even the smooth ones.
And some factors make some of them more stressful than others, right? Certainly, if you're working with a good loan officer, if you're working with a good buyer's agent, then it's going to be better for you, right? So ahead of time, make sure you're working with the buyer's agent and make sure you're working with a loan officer that you trust and are going to be good and know what they're doing. That's really important. But in the long term, when people are really stressed out about it, it just comes down to my job is to communicate how things are going with the buyer's agent, with the listing agent, with the buyer, all the people involved. I need to communicate how things are going. And if your loan officer is not communicating with you about those things, they're not doing their job.
Of course.
Right. Yeah. Again, even the smoothest transactions. I just closed a super smooth transaction. These folks were moving from the South. They're moving from North Carolina up to Maine. They were nervous. Of course they're nervous. They're packing up their entire lives, putting into a moving truck, driving, 1,500 miles or whatever the distance is, to come here. It was overnight to drive. They want to make sure everything's all set.
Of course.
Right. Yeah. Before they pick up their entire lives and move, 7 or 8 states away or whatever it is. Right. It can be stressful, even the easy situations. And every time they call and ask questions, like, guys, just understand, if there's something to be worried about, I will let you know.
Of course.
If there's something to worry, if you're not hearing from me, that no news is really good news, right? But in the end, it's just being prepared ahead of time is going to help you to not be stressed throughout the process.
Of course, yeah. And keeping that open line of communication and knowing that even if you're not communicating with them, that sometimes isn't a bad thing.
And knowing that you can call me at any time.
Of course,
even if I'm not reaching out and I have nothing to tell you, like I try to reach out at least once a week just to say, hey, even if nothing's going on, check in, nothing's going on. We're just in the process still. If you want to call me 3 times a week to check in, that's fine.
Yeah.
I'm okay with that. I would rather you feel comfortable and know, yep, everything's okay. Answer your questions. I work with a lot of first-time home buyers that they've never done this before, right? So I want to be able to answer their questions. I want them to feel comfortable coming to me so that they're not stressed.
Of course. Since we are on keys to the 603 being New Hampshire, let's talk about New Hampshire for now. So let's talk about New Hampshire specific programs that you know of, or certain things in New Hampshire that can help first-time homeowners or people who may not have a lot of money for a down payment. What things does New Hampshire have to offer?
Yeah, so if you're buying a house in New Hampshire and you're a first-time home buyer, the first thing you want to look at is New Hampshire housing. New Hampshire Housing has some great loan programs. Every state has their own HFAs, which is Housing Finance Authorities. Maybe I'm a little bit biased, but New Hampshire Housing is one of the best.
Right.
I really do like their programs. They're simple to use. They're straightforward, and a lot of people qualify for them. They do have income limits. They have purchase price limits on most of the programs. And that varies by area. If you're buying in Rockingham or Stratford County, those limits are probably going to be a little bit higher. If you are single or you're a couple, it might be a little bit different than if you have children, dependent. So it's kind of 1 to 2 people or 3+ for some of the programs. But most of their programs are below market interest rates. So you're getting a subsidized interest rate. you also have the potential. You all have the potential for down payment assistance. They have all of their programs allow you to do $5, $10, or $15,000 of down payment assistance. That goes on as a silent second loan. When they silent second, meaning it's a second mortgage that you don't make payments on, that doesn't accrue interest. It just sits there on your property waiting. And so when you pay off that first loan, it becomes due on that point. So if you refinance or if you sell the house, it gets added into your payoff amount.
So it's a really great way, it sounds like, for new home buyers to really have something additional to contribute to a down payment. For somebody who might not have.
I've had people that have gotten a check back at closing.
Wow.
Because I worked with the realtor to say, okay, these people don't have a lot of money. They've got that upfront. They're paying for their appraisal. They're paying for their inspections. Or they have their earnest money deposit. And then they get some of that refunded back to them because we use down payment assistance through New Hampshire Housing. And they were able to negotiate a seller credit to cover closing costs.
Perfect.
And so that's why I say that assets part of that triangle, remember?
That
assets part is the easiest one to overcome.
Of course.
Because we have tools and ways to negotiate our deals and things like that to help them in those situations.
And I imagine a lot of listeners right now who are looking to buy a home in New Hampshire who are worried about that that initial down payment or that upfront cost. How can they get involved with that? Do they just reach out to you and then you
reach out to a loan officer? Yeah.
Perfect.
So myself or another loan officer that's with works with New Hampshire Housing. If you go to New Hampshire Housing's website, go newhampshirehousing.org. There is a build your team link in there. We can go in and if you choose you can choose loan officers, and it shows all their loan officers that are involved with New Hampshire Housing, all the lending companies, and there's even a section for real estate agents that they've worked with. That you can look at real estate agents that are familiar with New Hampshire Housing's programs. But really, it's the loan officer, right? Even if the realtor's not familiar with it, I talk to realtors all the time that aren't familiar with it. They don't really need to be familiar with it.
Yeah.
It's nice when they are,
of course,
but they don't need to be, because really it's the lender, right? It's a loan officer that you want to make sure is familiar with the programs, and not every mortgage company or bank has access to them. So you want to make sure who you're working with has access to those programs. And I mean, if you go onto that right now, if you go onto that page, that build your team page, you click on loan officers, you're going to see my silly face right on the front there. I'm one, it's on the top, not on the top of their list, but I'm one of the top loan officers. So I'm on that first page, and you can click on there to get my contact information or to reach out to me directly, or anybody else on there. If you think somebody else is prettier than me.
Probably if someone else has like a nicer beard,
Yeah.
Mine's not as
there
nice
are a few
yours.
out there, but if they have nicer facial hair than I do.
Of course, a few lumberjack looking guys.
Yes. Yeah, exactly.
Awesome. So there are a lot of small businesses in New Hampshire. And since I'm going to be interviewing a lot of small businesses on this show, what can small businesses do in the mortgage process to better help them? Because I know it's probably slightly different than people with the W-2.
You mean somebody that owns a small business,
someone who
self-employed?
Yes,
right.
A self-employed small business.
So if someone is self-employed, it's going to depend on how their business is structured, whether they're a sole proprietor, an LLC, S corp, so that's going to be a little bit different. But in the end, it's going to come down to your tax returns, right? Generally, if you've been in business for 5 years or fewer, they're going to want to see 2 years of tax returns. More than 5 years, generally 1 year. But again, that's very generalized. Every program is going to be a little bit different. But they're going to look at your tax returns. They're going to look at that Schedule C or your K1. And there are certain things that we can add back in that you might have deducted. But so mortgage lending and tax returns kind of work against each other in a way, because as a small business owner, you want to pay the least tax possible.
Correct.
Right. And so you're going to write off every last thing you can, and your cat food and your whatever, if you have a good CPA, man, they can find all sorts of things to lower your tax liability. Well, the problem is that we're going to go on net profit, which is after all of those deductions, right?
Yep.
So somebody could be making $150,000 a year, but their tax return says they make $20,000 a year.
Because they've deducted everything.
Which it may be totally legal deductions. I'm not saying they're not legal deductions, but they deduct everything, and then they come to me and they go, "How much do you make?" "Oh, $150,000 a year." "Oh, well, that'll be fine. Perfect."
Of course, yeah.
"Let me your tax returns," and I see $20,000 because everything's done. Well, now $20,000 is not going to buy you a house, right? So there are certain things we can add back in: depreciation, things that are not actual dollars spent
Of course,
that you're
yeah.
deducting, mileage on your vehicle, things like that. We can add some of that stuff back in. There's a whole, formula for that. But if you're thinking about buying a house, keep that in mind when you go to your tax attorney or tax accountant rather.
Of course.
And let them know, hey, I'm going to be buying a house this year, so I don't necessarily want to show no income. Right. The other way to go about it, though, is if you have enough of a down payment, your credit's good enough, there are what we call non-QM or non-qualified mortgage. And it's not really a misnomer. It's not about qualified mortgage or not, but it's just that there are specific investors that will do loans that don't get sold to Fannie Mae, Freddie Mac, things like that, right? So when we have those particular ones, we have something called a bank statement loan. So if you are in that situation where you don't show a lot on paper, but you make good money, you can do a bank statement loan where we actually provide your last 12 or 24 months of bank statements. And we use the income of that plus an expense factor, which is based on what your business is and what you do. That we send in to the investor, and they'll actually give us an amount. I had one that I was doing a refinance for last year, and he showed me his tax returns, and I came out, okay, you got about $6,000 a month of income. All right. So that wasn't enough to do his refinance, $6,000 a month of income. We looked into the bank statement loan, sent that in to the investor, came back, the investor says, great, you can use $18,000 a month of income. Because they're not looking at all those different deductions.
Of course,
right?
yeah.
They're giving them an expense factor across the board.
Yep.
This is where we're adding up all of the income that you brought in, and then we're taking a percentage of that toward expenses. Everything else is yours. And that gave him, it tripled his monthly income.
Yeah, that's
so
insane.
we were able to close the loan.
Wow.
So that's when I talk about every situation is different, but for self-employed buyers, that's definitely a good tool in the tool belt. That if you're looking as for investment properties, like a DSCR loan, which is a debt service conversion ratio loan, meaning that the actual investment property is paying for itself. So we don't take your income into account. So if you're self-employed and you want to buy an investment property, we don't even need your tax returns. We don't need your debt. As long as you're minimum credit qualifying and you have the down payment that's required for the loan program, we're going to look at, is the property going to be profitable? Well, can the rent that you get from that investment property cover the mortgage payment?
Of course.
And we just use that, and we don't consider your debt or your income.
Wow.
So those are some things that, especially for self-employed buyers, that you can look at. But if you're talking about for their primary home, they're buying a residence.
Of course, yes.
Because the DSCR loan is just for investment properties.
Gotcha. Yep.
But a bank statement loan is a good option if they don't have that bottom line. But I'm always going to say, just know that you can't pay no taxes and buy a house with like a conventional loan.
Of course, yeah. It's definitely going to be a little bit of a different process for you to get them what they need. But important takeaway here for people who do own small businesses who want to buy a home. Sounds like you should definitely reach out to a loan officer early so you can start planning ahead.
Even more important
like
than, obviously I always say it's never too early to talk to a loan officer and get that pre-approval done, right? Because even if you're not ready yet, at least you have a framework,
of
right?
course.
For a self-employed buyer, it's all the much more important because it's a lot more involved with the tax returns. Or do we go with a bank statement loan? Or there's all sorts of different things, and there might be more documentation you need to provide. So all the more important to reach out early.
Absolutely. Perfect. Is there anything else that you wanted to add in on today's episode that I didn't ask about?
I don't think we covered a lot, man.
We did cover a lot.
There's a lot. And
kudos to those who are still listening.
And we really only scratched the surface. Like a lot of these things that we talked about today, there's so much nuance to it.
Of course.
Again, anybody that's listening, that's looking to buy a house might be like, really, you need to talk to a loan officer about your specific situation. Nothing you heard here today can be applied to everybody across the board.
Correct. It's going to be different.
It's going to be different
where
for
you are,
everybody.
Who you work with.
It's like I said at the very beginning, depending on where you're buying, depending on what kind of property you're buying, depending on your credit, depending on your debt. Like there's so many factors that go into it that every pre-approval is its own separate thing. There's nothing that you can generalize.
Of course. Of course. Perfect. So thank you for all that information that you've provided. That was fantastic. How can people reach out to you if they have questions or if they're interested in using your services?
Yeah. So you can email me. It's wgaudet, Gaudet at totalmortgage.com. You can find me on Instagram, Bill Gaudet Mortgage, or on Facebook, Bill Gaudet Mortgage, Bill Gaudet Loan Officer, Bill Gaudet Mortgage. You can find me on all those places. DM me, email me, send me a message. I'm available. But you can
Perfect.
also just Google my name and I'll probably pop up.
Yeah, your mug shows up.
Yep. Yeah. Or billgoddetmortgage.com is
Yep.
another one that
Yeah,
I have.
you're
That I
there.
own that domain. It'll pop up with my website with all my contact information. So I'm pretty easy to find.
Perfect. Cool. Thank you very much.
Thank you.
Thank you, all those listeners who stayed in for the duration of the episode. I appreciate you guys, and I hope to see you again on more episodes. If you need to reach me for any real estate related matters, you can email me at shane.bevis@verani.com. I have a Facebook, an Instagram, a YouTube. It's all Shane Bevis Realtor, and I have additional contact information on there. So feel free to reach out anytime you have any questions. If you have any mortgage related questions, you can ask Bill. You can ask anyone else that you would prefer, but I like Bill.
Me too.
Yes, Bill is nice. Perfect. So thank you very much, and I'll see you again in the next episode.